What if I told you that the next massive move for XRP won't come from a random tweet, retail hype, or false hope, but from a multi-trillion-dollar institutional shift happening right now beneath the surface? Today, we are stripping away the noise to show you the real structural flows of capital that are about to change everything. What is actually going to send XRP to a dramatically higher price? Not hope, not hype, not a random tweet, but real structural flows of capital, regulatory clarity, institutional balance sheet deployment, and a shift in global liquidity dynamics that most investors still don't fully appreciate. Let's simplify this. Let's strip away the noise and let's look at what truly moves markets. We are living through a macro transition period. Global liquidity tightened aggressively over the last 2 years as central banks fought inflation. Interest rates rose, dollar strength surged, and risk assets compressed. That environment suppresses speculative flows and dampens capital velocity across financial markets. Crypto does not exist in isolation. It is a high beta liquidity asset class. When global liquidity contracts, crypto compresses. When liquidity expands, crypto accelerates. Now, here's the critical shift. We are moving from a tightening regime toward an eventual easing cycle. It doesn't happen overnight. It never does. But bond markets are already signaling it. Yield curves are normalizing. Inflation expectations are cooling. Fiscal deficits remain large. Debt servicing costs are rising. Eventually, policy adapts. And when liquidity re-enters the system at scale, it does not trickle. It floods. This is where the velocity argument around XRP completely falls apart. For years, critics claimed that because XRP is designed as a bridge asset for payments, its high velocity would suppress price appreciation. The theory suggests that if a token moves quickly and does not need to be held, then price cannot meaningfully rise. That sounds elegant. It is also incomplete. Let's step back and examine Bitcoin. Bitcoin has no intrinsic yield. It does not represent cash flows. It is not used for daily commerce at scale. And yet it rose from pennies to over $100,000 purely on speculative demand and institutional accumulation. Why? Because velocity collapsed. As holders treated Bitcoin as a store of value, they removed supply from circulation. Multi-year holding periods increased. Scarcity intensified. Capital inflows overwhelmed transactional usage. The exact same principle applies to XRP under the right structural conditions. When trillions of dollars of tokenized assets move on-chain, liquidity density becomes critical. David Schwartz has addressed this directly. A higher XRP price improves liquidity efficiency. It reduces slippage. It reduces fragmentation. It minimizes corridor imbalances. If institutions are settling large value transfers, they do not want to move millions of tokens for a single transaction. They want fewer units representing higher value. Price appreciation becomes functional, not speculative. And this is where we move from theory to infrastructure. Trillions of dollars in bonds, equities, derivatives, and credit instruments are in the process of being tokenized. This is not a crypto narrative. This is a financial market transformation narrative. Tokenized treasuries are already live. On-chain funds are already operational. Collateral mobility is accelerating. As these markets scale, they require neutral settlement layers. The XRP ledger is positioned directly within that evolution. Now let's look at what's happening operationally. Binance has listed RLUSD on the XRPPL for spot pairs and approved it as collateral. That may sound like a routine listing. It is not. When a regulated, high-quality stablecoin becomes eligible margin on one of the world's largest derivative venues, something important happens. Balance sheet capital becomes more efficient. Collateral fragmentation decreases. Institutions gain optionality. Derivative markets drive global liquidity. When stable collateral integrates into those markets, capital moves faster and at larger scale. This is market structure maturation. Ripple has spent approximately $2.7 billion acquiring infrastructure since 2023. Custody through Medico, prime brokerage through Hidden Road, now Ripple Prime, treasury services through Standard Custody, and others. These are not speculative purchases. These are plumbing acquisitions. They are building rails for institutions. And institutions do not deploy capital until 3 conditions are met: regulatory clarity, operational readiness, and liquidity depth. We are approaching all 3 simultaneously. Now, layer in Washington, crypto legislation is closer than it has ever been. Stablecoin frameworks are being actively negotiated. The White House Digital Asset Council is openly discussing yield structures, broker-dealer permissions, and settlement frameworks. There is compromise. There are political tensions, but the direction is forward. Regulation is not about perfection. It is about certainty. Markets price certainty aggressively. When institutions can model compliance risk, they allocate. When banks are permitted to hold and deploy stablecoins, the liquidity flywheel accelerates. This is not about retail speculation. This is about sovereign capital, pension funds, asset managers, and global banks. Meanwhile, macro volatility continues. Tariff rhetoric creates short-term turbulence. Equity indices pull back. The Dow drops hundreds of points on trade tensions. Headlines amplify fear. But beneath the noise, infrastructure keeps building. Short-term volatility distracts. Long-term structural shifts compound. And that brings us directly to XRP. For XRP to move dramatically higher, three forces must converge: liquidity expansion, institutional adoption, and regulatory clarity. Liquidity expansion drives capital into risk assets broadly. Institutional adoption drives structural demand for settlement liquidity. Regulatory clarity unlocks compliance-based allocation. When all three align, price does not move incrementally. It reprices. We are not there yet, but the pieces are assembling. Now, let's go deeper into why this matters specifically for crypto. Crypto is transitioning from a speculative frontier asset class into financial infrastructure. The first cycle was retail-driven. The second cycle was venture-driven. The next cycle is institutionally driven. That transition changes everything. In a retail cycle, narratives dominate. In an institutional cycle, capital efficiency dominates. Institutions care about collateral quality, capital charges, balance sheet treatment, settlement finality, and counterparty risk. They care about whether assets integrate into existing financial plumbing. This is why stablecoins matter so much. When regulated stablecoins are permitted to function as eligible collateral in derivative markets, they become foundational instruments. They are no longer just trading pairs. They become financial infrastructure components. RLUSD being integrated into major exchange collateral frameworks signals confidence. It reduces fragmentation between venues. It streamlines liquidity. And when collateral is unified, capital velocity increases. Now think about XRP inside that structure. If XRP functions as a bridge asset across tokenized bonds, equities, derivatives, and on-chain loans, it becomes embedded in settlement flow. That does not eliminate volatility, but it changes the base layer demand profile. The velocity argument assumes constant supply turnover with minimal holding demand. Institutional settlement changes that market makers must hold inventory. Liquidity providers must hold reserves. Prime brokers must manage exposure. Treasury desks must manage buffers. When trillions move on-chain, even small reserve allocations create substantial demand. And here is where price reflexivity emerges. Higher price improves liquidity density. Improved liquidity density attracts larger settlement flows. Larger settlement flows require deeper liquidity pools. Deeper liquidity pools justify higher price stability. This is a positive feedback loop. Now let's address the regulatory angle more directly. The clarity framework being debated in Washington is not simply a classification exercise. It determines jurisdiction, reporting standards, custody permissions, and institutional onboarding processes. If digital assets are clearly defined under commodity or security frameworks with tailored compliance pathways, institutions can allocate without existential legal risk. The White House Crypto Council has indicated that compromise is close. Stablecoin legislation appears nearer to completion than ever before. Stakeholders understand that innovation will not wait. Global competition matters. If the United States creates a workable regulatory framework, capital remains domestic. If it delays, capital migrates offshore. Lawmakers understand this tension. For XRP, regulatory clarity is existentially bullish. Ripple has spent years navigating enforcement uncertainty. Partial legal clarity has already been achieved. Further legislative definition removes residual overhang. When that overhang disappears, valuation models expand. Now, let's zoom into the institutional angle. Ripple Prime integrates brokerage, custody, and liquidity services. This is not a retail offering. It is built for hedge funds, asset managers, and institutions that require institutional-grade execution. Medico enables bank-level custody infrastructure. That matters because banks will not hold digital assets without compliant custody frameworks. Standard Custody integrates regulated trust services. These acquisitions create a vertically integrated stack. Think of it as building a digital asset investment bank. When infrastructure is vertically integrated, onboarding friction decreases. Institutions prefer simplicity. They want one relationship, not 10 fragmented service providers. Ripple is positioning itself as that consolidated gateway, and as tokenization accelerates, gateways become valuable. Now consider the global perspective. Central banks are exploring digital currencies. Commercial banks are piloting tokenized deposits. Asset managers are launching on-chain funds. Australia is hosting major XRP-focused events. Leadership from Ripple, including Brad Garlinghouse and David Schwartz, are publicly discussing stablecoins, cross-border payments, and tokenized assets. This is not theoretical development. It is operational expansion. Every conference, every pilot program, every institutional partnership compounds network effects. Markets often underestimate compounding until it becomes visible in price. In the short term, macro headlines still dominate. Trade tensions, tariff threats, equity volatility, dollar strength fluctuations, risk assets remain sensitive to policy rhetoric. But remember this, liquidity cycles operate on quarters and years, not days. Infrastructure cycles operate on years and decades. We are witnessing the infrastructure build-out phase. Price typically lags infrastructure. Once liquidity conditions ease and regulatory clarity solidifies, infrastructure becomes the launch pad. And that brings us to the short-term outlook. In the short term, XRP remains tethered to broader crypto market dynamics. If global liquidity tightens further or macro volatility escalates, downside pressure can persist. Markets move in waves. Corrections are normal within structural uptrends. But beneath surface volatility, key indicators are improving. Stablecoin legislation progress reduces systemic uncertainty. Institutional custody integration expands access. Derivative collateral approvals increase capital flexibility. Each of these developments reduces friction. Friction reduction is cumulative. Now, consider what happens when the Federal Reserve eventually shifts toward easing, whether through rate cuts, balance sheet adjustments, or liquidity facilities. Capital rotates quickly. Bitcoin historically leads liquidity expansions. Ethereum follows. Then capital rotates into high beta assets with strong narratives and improving fundamentals. If XRP enters that liquidity expansion phase with regulatory clarity, institutional rails built, stablecoin integration active, and tokenization accelerating, the repricing could be substantial. Markets do not gradually reward structural shifts. They revalue abruptly. We saw it with Bitcoin ETFs. Years of anticipation, then approval, then billions in inflows, catalysts, compressed timelines, now extend the horizon further. The long-term outlook for XRP depends less on retail enthusiasm and more on financial system transformation. If tokenized assets represent even a modest percentage of global bonds, equities, and derivatives over the next decade, we are talking about tens of trillions in potential on-chain value. Even capturing a fraction of settlement flow across that ecosystem is meaningful. And remember, XRP does not need to absorb all value. It needs to facilitate value transfer. Liquidity pools scale with usage. As usage scales, liquidity deepens. As liquidity deepens, volatility compresses. As volatility compresses, institutions allocate more confidently. This is how infrastructure assets mature. The velocity critique assumes static conditions. Markets are dynamic. Institutional behavior alters token economics. Regulatory clarity alters capital allocation. Liquidity cycles alter risk appetite. All three forces are aligning. Final insight: XRP's path to significantly higher prices is not dependent on hype cycles or social media momentum. It depends on macro liquidity returning, institutional rails activating, regulatory frameworks solidifying, and tokenized asset scaling. We are watching the early stages of that convergence. The market is impatient. Infrastructure is patient. When liquidity expansion meets infrastructure readiness, repricing becomes inevitable. If you found value in today's breakdown, don't forget to like the video and subscribe.